What's up, y'all? Welcome to the first installment of Advanced Fundamental Analysis, where I will be little by little going over different concepts to assist you with evaluating your long-term investments on a bit of a deeper layer. Um, as I mentioned in last week's video, I'll be discussing PE ratio and PEG ratio. Um, PE ratio is a very popular and widely used metric that analysts use to determine, relative expense of a company, whether it be overvalued or undervalued. Um, and to put it simply, it's just a ratio of the company's share price to the earnings per share. So how much money that company earns per share. So let's say, for example, company ABC, their share price is 20 bucks, 20 bucks a share, and their earnings is 5. So putting that together, that would mean that their PE ratio would be 4. So just a very simple calculation as far as PE ratio is concerned. But where I really want to kind of get into PE ratio is, or why is, the markets are generally at an all-time high, uh, continuing to climb higher. And you hear a lot of talk about PE ratios ballooning out of control. And the way that I was taught to look at the PE ratio was to, of course, compare it to the same companies in the same industry, or competitors of the same industry, and the industry average, and then that would give you an idea as to relative value of that particular company. So I want to take it a little bit deeper than that and think about and have you guys to think about uh, how PE ratio can be influenced. So when you think about the calculation that I just gave you for PE ratio, just simple basic mathematics, you know that if uh, things that can increase the PE ratio is, the numerator, that being the share price, outpacing the growth of the numerator, outpacing the growth of the denominator, being the earnings per share. So that's one thing that was really that was happening, or has been happening with a lot of companies. And it doesn't necessarily, to me, give a good indication of whether the company is, a worthy investment. Um, we all know that pure demand can drive the price of a stock. And it doesn't have to be necessarily anything material to the company itself. It could be, some news or whatever. It could be a pump and dump, whatever. It could be, just anything that influences supply and demand. And that alone could drive the price of a stock. And that price movement can really outpace the earnings, which would cause an increase in the PE ratio. So that, looking at something like that, you could say, this company is relatively expensive. The share price is growing faster than the earnings that the company is bringing in. So one thing that you want to look at is, how has this company's EPS, earnings per share, grown over the same amount of time, that the share price has been increasing. And, are they growing at, fairly similar rates? Um, Another thing, of course, that could increase the PE ratio is a decrease in the denominator, that being the earnings per share. So is that something that's happening? You could have, those two numbers could be going in opposite directions, really influencing the PE ratio. Um, and that's just something to look for and to consider in your evaluation of the numbers. Um, for me personally, the PE ratio alone doesn't give me the best picture. I think I can get a better picture by throwing in another metric to help me to determine um, whether this ballooning PE ratio is really uh, okay, and not something that I should just wait for it to come down, at some point in the future. And that's the PEG ratio. So the PEG ratio is just the price to earnings growth. So basically, that one takes the PE ratio and puts it um, over the expected earnings per share growth. So basically, the calculation is PE ratio divided by earnings per share growth. So let's say, that company ABC, PE ratio of 4, but their earnings per share growth is, I don't know, 8%. So that would give that company a PEG ratio of zero point 0.5. So that number would tell me, okay, so obviously this company, their growth rate, the growth of their earnings is likely outpacing the share price. So this PE ratio, whatever it is for this company, is justified, whether it be what you would think would be a high PE ratio or not. But the earnings, the growth rate of their earnings really supports um, supports the high PE ratio. So, you could look at a company and their PE ratio could be, oh man, PE ratio could be, let me try to think of an example real quick. PE ratio could be, uh, let's say 300. Um, no, 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 no. Let's say the PE ratio could be 50, right? 50. But the industry average for this particular company um, might be 25. So just looking at that, you're saying, oh well, the PE ratio is too out of control for this company, so I'm going to consider this company as overvalued based on that relative to its competitors in the industry. But what you don't consider is the relationship between the PE ratio and the earnings growth. Is the earnings growing in that same amount of time that the share price is also growing, right? So you look at the PEG ratio and then you find out, that the PEG ratio or the earnings per share growth is, what we say the PE ratio was 50. Let's say that the earnings per share growth rate is, I don't know, like 100. We'll just say 100. For some companies, it's not really far-fetched, like Zoom. Incredible growth lately due to COVID, but let's say 100. So PEG ratio in that case is zero point 0.5 again. Um, that right there gives you a better picture of the relative value of a company, whether it's overvalued or undervalued compared to the industry and compared to its competitors. So just looking at the PE ratio alone isn't enough personally for me. I like to throw the PEG ratio in there just to kind of try to get a better picture of the relative expense of the company or inexpensiveness of the company. So if I get a PEG ratio of, generally less than 1, then I know that the earnings per share growth rate is um, it's greater than the PE ratio. And then on the flip side, if the PEG ratio is greater than 1, then that lets me know that the earnings per share growth rate isn't keeping up with that PE ratio. And so I may want to wait until that PE ratio comes down a little bit, or that earnings per share growth rate grows a little bit. Basically, I want to wait till that PEG ratio comes down a little bit before I buy in. So it might be a little too expensive um, at that current uh, with those current considerations for me to buy it. So, um, is there anything else I want to say about PE ratio and PEG ratio? Mm, Not really. Just quick recap. Think about the things that drive share price, supply and demand. Think about whether or not that information is material to the company or not. And also consider the earnings per share and how it's growing. So, and look at the relationship between those factors for that particular company. So, um, just a little bit deeper layer than just looking at the P/E ratio and comparing it to the industry and competitors, which is a great thing to do. But just wanted to give you a little bit more information on how you can look at it a bit more deeply than that. So that's all I got. If you have any questions, any feedback, leave it in the comments. Send me an email, send me a message. I welcome it all. Thanks for listening.